If you took $30,000, put it into just 3 index funds, and then did absolutely nothing else, no trading, no checking, no touching it, history says that money could grow to somewhere around $200,000 over the next few decades, from 3 funds that you never touched. And here's the part that surprises people. The best 3 funds for doing this are not the exciting ones. They're not the hot tech pick everyone's posting about. They're almost boring. But there's a reason this exact combination is the single most copied long-term investing strategy of the last decade. And by the end of this video, you'll understand exactly why these 3, in what amounts, and what that 30 grand could realistically turn into. This video is for you if you've got a lump sum sitting there. Maybe you sold something, got an inheritance, saved it up, got a bonus, and it's just sitting in your bank account doing nothing because you're scared of putting it in the wrong place and messing it up. Or maybe you don't have the 30 grand yet, but you want to know exactly where it should go when you do. Either way, I've got you. And I'll be honest with you up front, I wish someone had shown me this exact setup when I was starting. I wasted a lot of time chasing complicated, clever-sounding strategies when the boring answer was sitting right there the whole time, quietly beating most of what I was doing. So let me just hand it to you. Quick thing before we get into it, this channel is still small, and a like genuinely tells YouTube to push this to the next person sitting on money they're afraid to invest. Costs nothing, takes a second, actually helps. Okay, let's build this. First, I need to reframe one word because it changes everything. The word best. When most people hear the best index funds, they think it means the ones with the highest returns, the ones that shot up the most. But that's not what best means here, and chasing that is exactly how people get burned. In investing, best for building long-term wealth means something different. Simple, cheap, broadly diversified, and proven over decades. Not the flashiest, the most reliable. Because here's the thing, the fund that returned the most last year is very often the one that crashes the hardest next year. The strategy that wins over 30 years is boring, steady, and spread out. So when I say these are the best 3, I don't mean they'll make you the most money the fastest. I mean they're the ones that have quietly, reliably worked for decades with almost no effort and almost no cost. Keep that in mind, because it's the whole philosophy. So what are they? This famous combination has a name. It's often called the 3-fund portfolio, and it's built from 3 simple pieces. Let me walk you through each one and exactly what job it does. Fund number 1, a US total market fund. This is your engine. This single fund buys you a tiny piece of essentially the entire US stock market. Not just the big names, but thousands of American companies, large, medium, and small, all at once. A popular example tracks around 3,700 US companies in one purchase. When people talk about just buy the market, this is what they mean. You're not betting on one company or guessing which stock wins. You own a slice of all of them. Now, you'll also hear about S&P 500 funds, which hold the 500 largest US companies. And honestly, for most people, a total market fund and an S&P 500 fund are almost interchangeable. They move together about 99% of the time because those big companies dominate either way. Total market just includes the smaller companies too for a little extra breadth. Either one works as your engine. This piece is where most of your growth is going to come from over the years. Fund number 2, an international fund. This is your diversifier. Here's a mistake a lot of people make. They put everything into US stocks and forget the rest of the planet exists. But the US is only about 40% of the world's total stock market. There's a whole world of companies out there. An international fund buys you a piece of thousands of companies outside the US, Europe, Asia, emerging markets, all of it. And I have to be honest with you here, because this is where a lot of finance channels aren't. International stocks have actually underperformed US stocks for about the last 15 years. So you might be thinking, why hold them at all? Fair question. The answer is insurance. Nobody knows which region wins the next decade. US has dominated recently, but that hasn't always been true. And valuations overseas are cheaper right now. Holding international isn't about guaranteeing more return. It's about not betting your entire future on one country, continuing its winning streak forever. It's diversification insurance. Some people skip it. I'm giving you the classic, fully diversified version. Fund number 3, a bond fund. This is your shock absorber. The first 2 funds are stocks. That's your growth, but stocks are volatile. They can drop 30, 40% in a bad crash. A bond fund does the opposite job. It grows slower, but it's far more stable. And it cushions the fall when the stock market has one of its ugly years. Think of bonds as the airbag. You hope you don't need it, but when the market crashes, the person holding some bonds sleeps a lot better and doesn't panic. Sell at the bottom. How much of each? This is the part that depends on you, and I want to be careful here because there's no single right answer. But let me give you a common starting point that a lot of long-term investors use, just so you have something concrete. For someone with a long time horizon, a classic split is around 60% in that US total market fund, 30% international, and 10% bonds. On your $30,000, that's roughly $18,000 in US, $9,000 international, and $3,000 in bonds. Now, if you're older or closer to needing the money, you'd want more in bonds for safety. If you're younger and can stomach the swings, you might hold fewer bonds. That's the one dial you adjust for your own life. But that 60-30-10 gives you a real picture of what a balanced, diversified 30 grand actually looks like. Now here's something I promised I'd get to, and it's the quiet superpower of this whole strategy: the cost. This entire 3-fund portfolio costs almost nothing to own. We're talking an average expense ratio of around 0.05%. On your $30,000, that's about $15 a year. $15 for the whole thing. Now compare that to a typical actively managed fund, where some manager charges you around 1% to pick stocks for you. On $30,000, that's $300 a year, 20 times more. And the brutal truth is, those expensive managers usually underperform these boring index funds anyway. So you'd be paying 20 times more for worse results. And that fee gap doesn't just cost you a little. It compounds against you every single year for decades. Keeping your costs near zero is one of the biggest and most overlooked advantages you can give yourself. This is why cheap and boring wins. Okay, now the fun part, the what if. What could that $30,000 actually become? I want to be really clear before I show you these numbers. These are illustrations based on historical stock market averages, not promises. The market does not go up in a smooth line. Some years it soars, some years it crashes, and the past does not guarantee the future. But history gives us a reasonable range to imagine with. The US stock market has historically returned somewhere around 7% a year after inflation over the long run. So let's use that as a grounded, even conservative assumption. If you invest $30,000 and just leave it completely alone, after 10 years at around 7%, that 30 grand becomes roughly $59,000. You nearly doubled it, doing nothing. After 20 years, it grows to around $116,000. And after 30 years, that single $30,000 investment becomes roughly $228,000 from 30 grand you never added to. And if the returns come in higher, closer to the market's long-run average of around 10%, that same $30,000 over 30 years could grow to over $500,000. $500,000 from one lump sum left alone. And remember, that's assuming you never add another dollar. If you kept contributing along the way, even a little, those numbers climb dramatically higher. The lump sum by itself is basically the floor. Now I need to give you the honest caveats, because if I don't, I'm doing you a disservice. 1. Past performance does not guarantee future results. Say it with me. The next 30 years might look different from the last 30. 2. The market will crash at some point during your journey. It always does. There will be years where your 30 grand looks like 20 grand, and it will feel awful. The people who win are the ones who don't sell in those moments. 3. That international fund might keep lagging, or it might be exactly what saves you in the next decade. Nobody knows, which is the entire point of holding a bit of everything. And 4. One current risk worth naming honestly. The biggest US companies now make up a huge chunk of the S&P 500, the most concentrated it's been since the 1970s. That's a real thing to be aware of, and honestly, it's another quiet argument for diversifying beyond just the top US names. Now, I know some of you are thinking, what about the exciting funds? What about the tech-heavy ones that have been crushing it? And yeah, a NASDAQ-focused fund has beaten the S&P 500 over the last 10 years. It's tempting, but it comes with much higher concentration and much bigger drops when tech falls out of favor. If you want to add a small spicy slice, some people do, but it's a higher risk tilt, not the foundation. The 3-fund core is the boring, proven base. Anything spicy goes on top in small amounts, not underneath. Quick note, I'm showing you how this strategy works and what history suggests, not giving you personalized financial advice. The specific funds I mention are just the well-known examples of each category. Your age, your timeline, and your risk tolerance are yours, and they change what's right for you. So let me bring this all together. The best 3 index funds aren't the flashiest. They're a US total market fund for growth, an international fund for diversification, and a bond fund for stability. Together, they give you a piece of basically the entire world's economy for about $15 a year. A common starting split is 60-30-10, adjusted for your age, and history suggests $30,000, left completely alone, could realistically grow into the low hundreds of thousands over a few decades, with all the honest caveats that the market is bumpy and the past isn't a promise. And this is the thing I really want you to take away. The reason I wish I'd started here is that it's simple, it's cheap, it's diversified, and it works. And while I was off chasing clever, this boring approach was quietly beating me. Simple beats clever, in investing more often than anyone wants to admit. So here's what to actually do. If you've got money sitting in your bank account losing value to inflation right now, don't let it sit there another 6 months while you look for something perfect. Understand these 3 pieces, pick your split, and start. Even beginning with a portion of it is better than leaving all of it frozen on the sidelines. If this made the whole thing feel less scary and more doable, send it to someone you know who's got money sitting in the bank too afraid to invest it. This might be exactly what they needed to see. And if you want more of this, clear, honest money stuff with no hype, you know what to do. I'll see you in the next one.